Hello. In this video, we're going to look at corporate redemptions problems. This is problem number 2. So this problem, we have Fruit Loop Incorporated, a C corporation, that creates children's breakfast cereals. And there's 100 shares of common stock outstanding owned as follows. Now, Fruit Loop has current EMP of $500,000. So we have 4 shareholders, orange, lime, lemon, and cherry. That makes up all 100 shares. And by the way, this is the only type of stock. There's no preferred stock. There's no different types of common stock. Okay, there's just this normal common stock. Vote. It's all voting. There's only one type of common stock. It's voting common stock here in this problem. So we're going to have 5 different variations. What we have here is variation 1. So this is what's going to change. All of this is going to stay the same up to where you see the breakdown. So orange owns 28 shares, which since there's 100 shares, that's 28%. Lime owns 25 shares, 25%. Lemon owns 24, 24%. And cherry 23, so 23%. So I've made it so it's easy to calculate the percentage there. So here's variation 1. Fruit Loop redeems. That's key because whenever you're looking at a problem, whether it's an exam problem or in practice, when we have a redemption, that's going to trigger a certain hat to look at. Fruit Loop redeems 5 shares from Lime, who is Orange's son, for $5,000 cash. The shareholders are otherwise unrelated. Lime's basis in the stock was $900 per share. Okay, so we have a redemption. Recall that whenever we have a redemption, we have to look at Section 302. Now, Section 302 specifically deals with issues, it classifies a redemption, which a redemption is when a shareholder sells his or its shares back to the corporation in exchange for cash or property. It's going to classify a redemption as one of 2 things. Either a Section 1001 realized gain or loss, which will be recognized, or a Section 301 distribution, and we're going to have to apply the distribution rules. In order to get a sale or exchange, we have to go through the 4 possible tests. If we meet any of those 4 tests, boom, we have a Section 1001 realized gain, which will be recognized. If we don't meet any of those 4 tests, we have a Section 301 distribution, and we apply the distribution checklist. So here, Fruit Loop redeems 5 shares from Lime, who is Orange's son, for $5,000. Otherwise, all other shareholders are unrelated. So let's go through the tests. We first start with test 1. Test 1 is the substantially disproportionate test. Substantially disproportionate test. Now remember that when we do these tests, we're always going to have to consider both direct and indirect ownership. Both direct and indirect. And that's important here because we're dealing with Lime. Lime is the one who has the redemption, but Lime is Orange's son. So we have potentially an issue of attribution under Section 318. Family attribution, we'll talk about that in a moment. So the substantially disproportionate test is purely mechanical. That's why we always start there. And under this test, we have to meet 3 separate tests. The first test is that the after percentage is gotta be careful there, is less than 50%. Okay, when you're looking at voting percentage. Next, the after percentage is less than, and there's a formula, 80% times the before percentage of voting common stock. And finally, the third test is the after percentage is less than 80% times the before percentage of all common stock. All common stock. Now, because this problem only has one class of common stock, which is voting, right? There's not voting, common stock, and non-voting in this problem. This test is going to be the same because it's going to equal the same thing. Or these 2 tests will be the same. So let's go through the first test, okay? And by the way, when we do this, remember we have to consider attribution. So our attribution rules, okay? We have family attribution. We have entity to investor, investor to entity. Here specifically, we have to worry about family attribution. We've got Lime. Orange's son is Lime. Okay? Now when we do this analysis, we focus on the person being redeemed. Okay? So we have Lime. That means that Orange is Lime's parent. Okay? Because it says that Lime is Orange's son. So Lime, Orange's son. So Orange is Lime's parent. So the rules for family attribution: spouses, children, grandchildren, and parents. Just those, okay? Remember, those are what we consider. So we have indirect ownership here. So that means that Lime is going to be viewed as owning the amount that Orange owns, okay? So the first test is the after percentage is less than 50% voting. So I always like to start with the before percentage. And this helps because let's say we don't get past this first test, it fails the first test, it can be helpful for later tests. So Orange has 28 shares, Lime has 25 shares. If we add those together, we get 53 out of 100, that's 53%. After. The after percentage, Orange still has 28 shares, that did not change. And again, because of indirect ownership, Lime owns those shares. Lime has 25 shares before, 5 shares redeemed, so that's 20. 20 shares redeemed. So that's going to be 48 over, how many shares are there? 100 minus 5, 95. 48 divided by 95, 50.5. 50.5%, rounded to one decimal place. So if we're looking at the substantially disproportionate test, we fail the first one. We don't get substantially disproportionate. So test 1 fails. So test 2 and test 3. Test 2 is complete termination. Well, in order to have a complete termination, even if you had a waiver of family attribution, the shareholder directly cannot own any shares. After this transaction, Lime still owns 20 shares. Therefore, complete termination is not possible. The next test to consider is partial liquidation. We're not told anything about partial liquidation here. So therefore, there's no partial liquidation plan in place. Therefore, that's not an option. So we only have one more test that's possible. And that is test 4. So let me put a line here to separate out test 1. Okay. So test 4. So test 4 is not essentially equivalent to a dividend. It's a mouthful. NEED. Not essentially equivalent to a dividend. Remember that not essentially equivalent to a dividend is the last test because it's the most subjective. Found in section 302B1. So this test, we're focusing on a meaningful reduction of a shareholder's proportionate interest in the corporation, control. And that was from the Davis case, still applies, still applicable law, and we focus on the voting percentage. Okay, which this right here. Okay. Now remember too that this can be very factual and subjective, but we do have 2 revenue rulings that are very helpful. Revenue ruling 75-502 and revenue ruling 76-364. Now, revenue ruling 76-364 deals with issues of concert, where one shareholder can team up with another one to get ownership. Well, under attribution, Lime actually owns more than 53% before, and after still owns more, still controls. Okay? So this is not a concert issue. Revenue ruling 75-502 deals with a situation where there's only 2 shareholders and a shareholder goes from 57%, so more than 50%, to equal to 50%. So I'm going to go ahead and tell you, with attribution or by themselves, whatever the ownership is, if a shareholder still has more than 50% ownership after the redemption, again, considering direct and indirect, more than 50%, you're going to fail all 4 tests. You're not going to be able to get test 1 because of the first requirement. And then test 4 fails as well because that's not going to be viewed as a meaningful reduction in control. That is known. Okay? So what does that mean? That means that this $5,000 is going to be treated as a Section 301 distribution. Okay? So we have a $5,000 Section 301 distribution. So the last question, which I'm going to address here, is what about the basis of the shares? So Lime has 25 shares, okay? 25 shares before the transaction at $900 per share. That's $22,500. So $22,500 basis total. Okay, again, I got that by taking the 25 shares before, multiplying that by 900 shares, get $22,500. Okay, if we took $22,500, divide that by 25 shares, we get $900, just math. But now, Lime only has 20 shares. Yes, we have attribution of Orange, but when we do the basis calculation, we only focus on direct ownership. So Lime has 25 shares redeemed, so Lime now has 20 shares. So 22,500 divided by 20 shares, that equals a new basis per share of $1,125, and that is the adjusted basis per share. Per share. Okay, so if you're trying to figure that out. So remember, whenever we have the 301 distribution, we basically have to reallocate the basis over the number of shares left over. And that's what we've done here. Okay, so that's variation 1. Again, it's going to be treated as a Section 301 distribution. So the $5,000 received has to go through the distribution rules, which, by the way, there's plenty of EMP, right? 500,000 EMP. So that would be treated as a dividend to Lime. And then that would reduce, assuming there's no other transactions, that would reduce the EMP down to $495,000. And the basis left in the shares, the 20 shares, is $1,125. So let's go on to the next variation. All right, so in variation 2, again, the facts stay the same up here. All that changes is below our little chart. That all stays the same. So in variation 2, Fruit Loop redeems 5 shares from Lemon. Now Lemon, who is Orange's daughter, for $5,000. The shareholders are otherwise unrelated. Lemon's basis in the stock was $900 per share. Okay, so we go through the same analysis, right? We know that we have a redemption. It's either going to be treated as, we have to look at Section 302. It's either going to be treated as a Section 1001 realized gain or loss, which will be recognized, or a Section 301 distribution. All right, so we go through our tests. Test 1, we have the substantially disproportionate test. I'm just going to abbreviate that SD. Remember, we have to have 3 things. We have to have the after percentage must be less than 50%, and that's voting. Second, the after percentage must be less than 80% times the before, and that's for voting as well. And finally, the same thing, after percentage is less than 80% times before for all common stock. So let's go ahead and apply that. Again, the way I like to focus on this is by looking at the before and after numbers. So here we have, again, family attribution. Okay, look at the attribution we have here. If we focus on the attribution, we've got Lemon is who's at issue, but Lemon's parent is Orange. So that's going to be attribution, just like we saw in variation 1. Just now we're due of Lemon. And by the way, all these variations are all independent variations. So Orange, we're focusing on the before percentage. Orange owns 28 shares. Lemon has 24. That's going to equal 28 plus 24 is 52%. Orange still has 28. Lemon now has 24 minus 5 is 19. 28 plus 19 is 47. How many shares are redeemed? We've got 100 minus 5 is 95. So 47 divided by 95, this is 49.4%. 49.5, my apologies for rounding to 1 decimal place. It's 49.5%. Okay. So if we're doing the substantially disproportionate test, yes, it's less than 50%. What about the 80% times before? And again, remember that these two are going to be the same. They're going to be the same test because we only have one class of common stock here. It's all voting. So if we take 80% times 52%, we get 41.6%. 41.6%. So the test is is 49.5% less than 41.6%? Is it? And the answer is no. So it fails these two tests, and therefore test 1 fails. Okay, so we go to test 2, complete termination. So again, for complete termination to apply, even if you have the family attribution waiver, Lemon can't have any shares of stock. So we failed test 2, complete termination. Test 3. So in test 3, we have partial liquidation. Nothing in the facts suggests a partial liquidation issue. So then we go to test 4, not essentially equivalent to a dividend. Test 4. Let me draw this out here. Give us some space. So test 4, not essentially equivalent to a dividend, NEED. Remember, this is a meaningful reduction in control. Proportionate interest in the corporation, which is viewed as voting, as a super factor, and we look at control, which that's the ownership here, is the control of the voting. Okay, so just like we saw in variation 1, there's really 2 revenue rulings we're going to focus on. Rev ruling 76-364 deals with the concert issue, which we don't have here because we have control just, again, direct and indirect together. So that's all viewed together, okay? So we have that already, and we don't have to worry about joining up with another person, an unrelated person. That's what revenue ruling 76-364 deals with. So that's not an issue here. That's if you are all unrelated and somebody can team up with another person to get control, but they lose that ability. We'll see that in another variation later on. So the only other revenue ruling to consider, because revenue ruling 76-364, the one we just mentioned, is irrelevant, is revenue ruling 75-502. So in revenue ruling 75-502, the taxpayer at issue went from 57% to 50%, which was viewed as a meaningful reduction in control. Now here we're going from 52%, more than 50%, to less than or equal to 50%. So that is very similar. So it's very, very, very likely this is going to be the case. The only thing that's working against this taxpayer is that in the revenue ruling, there was only 2 shareholders. Okay? So think about the situation here. If you have 2 shareholders, A and B, A owns 50%, B owns 50%, which is what happened in the after the redemption in revenue ruling 75-502. And there's a very important decision. Let's say the decision is for a retailer to close the brick and mortar stores and only do everything online going forward. A wants to close them. B does not. B wants to continue the brick and mortar and online. A wants to just do everything online. So that's obviously a decision that has to be made at the shareholder level. Very integral to the business if you're a retailer. So if A votes yes to close the brick and mortars, but B votes no, you're at an issue. Okay, you're at a stalemate. So here, through attribution, Lemon is viewed as having more than 50% ownership, so can make that decision. Again, it's viewed in family attribution with Orange, but still, technically speaking, under the tax law, Lemon has more than 50% ownership. Can you think of any possible way why this situation might differ from the situation of A and B? Where A, there's only 2 shareholders. Well, one thing I can think of is, after this transaction, right, 49.5%, if they were identical, if they were both 50-50, like we saw with A and B, then again, if A wants one thing and B wants nothing, and B wants the opposite, then there's no way they're going to be able to come to an agreement. What if you have Orange and Lemon, which again together, even though they're 49.5%, they have not one other person, but 2 other people. They could team up with Lime or Cherry. They could persuade one of those. So they might be Orange, Lime, and Lemon after the redemption. And if with the 49.5% of Lemon and Orange plus Lime, that of course is going to be more than 50%. So maybe Orange, Lime, and Lemon, they want to close the brick and mortar store, but Cherry wants to leave it open. That's a lot different than if it was just Lemon and Cherry. Lemon wants to close, Cherry doesn't want to, and there's no other person that Lemon can team up with. So that does make a difference there. However, the fact that the case, U.S. v. Davis, focuses specifically on a meaningful reduction in control, which is the shareholders' voting power, is the main factor. Going from over 50%, where you can simply control, to under 50%, I would still view that as a meaningful reduction in control. Even though you have that issue with the Rev ruling, still a strong argument. And I would say that this does meet not essentially equivalent to a dividend, because we're going from 52% to equal to or less than 50%. And that, again, when you look at the court cases, strong argument. Again, revenue ruling, only 2 shareholders here. We have 4 shareholders. So that's an argument on the side of the IRS. But I think the argument is still in favor of the taxpayer, because you're going from more than 50% to equal to or less than 50%. So I think that's strong. So I think here we have a Section 1001 sale or exchange in this transaction. So what does that mean? That means the amount realized is going to be the amount received, which is $5,000, minus the adjusted basis. So there's 5 shares that are being redeemed times the $900 basis per share. That's $4,500. There's a $500 realized and recognized gain. Assuming that Lemon has held the stock for more than a year, that's going to be a long-term capital gain. And finally, the last thing to note is that the adjusted basis of the remaining shares is still going to be $900 per share. $900 per share going forward. And that's the consequences. Those are the consequences. There are consequences also to the corporation Fruit Loop, just like we saw in Variation 1, Variation 2 as well, of EMP and those things, but we're not going to consider that in this problem. We're just focusing mainly on the shareholder. The consequences to the corporation would be we'd have to adjust EMP for these different things, but we're not going to look at that. We're just going to focus on these consequences, the long-term capital gain and the amount the amount of distribution and the adjusted basis per share going forward. So that is Variation 2. All right, so now we're going on to Variation 3. So in Variation 3, again, the facts stay the same at the top. Variation 3, Fruit Loop redeems 4 shares from Lemon, who is Orange's daughter, for $4,000. The shareholders are otherwise unrelated. Lemon's base is $900 per share. So the difference from Variation 2 is that now it's just 4 shares for $4,000 rather than 5 shares for $5,000. So again, going through all this, because you got to keep in mind what we're doing. We have the redemption issue. It's a redemption. Section 302 is what we use to determine whether the redemption is going to be Section 1001 or it's going to be Section 301 distribution. So we start with the first test. Test 1, substantially disproportionate, SD. Okay? And before I even do that, I'm just going to go ahead and let's just go calculate the before and after percentages, because we're going to need to do that regardless of the test, right? So attribution, we still have Lemon is at issue, just like Variation 2. Lemon and Lemon's parent is, let's put Lime. Love lemon and lime together. Orange, Lemon's parent is Orange, so we have attribution, boom. So the before percentage, Orange has 28, Lemon has 24. So that equals 52, which there's 100 shares, that's 52%. The after percentage, so that's not different from last problem, and that's fine. After percentage, Orange has 28, Lemon has 20. How'd I get that? Because there's 24 shares, 4 redeemed, there's now 20 that Lemon has. So this is equal to 48 over the total of 100 minus 4 is 96. 48 divided by 96 is 50%. So the first test, substantially disproportionate, the first subtest, remember, is that the after percentage must be less than 50% when you view voting, which there's only voting stock here. And guess what? We fail it because it's equal to 50%. So test 1 fails. Okay, test 1 fails, substantially disproportionate, SD. Test 2 also fails because in order to have complete termination, even holding aside the issue of family attribution waiver, we have the direct ownership by Lemon has to be 0, which is not the case. So test 2 fails, complete termination. Test 3, partial liquidation, not here, nothing in the facts to suggest partial liquidation. Okay, so then we go to test 4. Test 4 is not essentially equivalent to a dividend, NEED. Remember, this is the last test we do because it's the most subjective. The Davis case is where we really find this test, meaningful reduction of the shareholders' proportionate interest in the corporation, which we focus on control. Voting ownership is a super factor. Now, there's some revenue rulings to help us. Revenue ruling 76-364 deals with the concert issue where you have unrelated taxpayers and someone teams up with an unrelated taxpayer to gain more than 50%. We don't have that here because we have related and they already are over 50%. So the only other revenue ruling to consider then that we talked about is revenue ruling 75-502. In revenue ruling 75-502, the shareholder went from 57% to 50%. So you're saying, wait, that's exactly what we have here. 52% to 50%, right? More than 50% ownership, which is viewed as control, to exactly 50%, which is not control. The key, though, when it comes to revenue rulings, you got to pay attention to this facts. In this revenue ruling, 75-502, there was only 2 shareholders. Okay, there was only 2 shareholders. So let me draw it out for you. We have A and B. A owns 57%. B owns 43%. That was before. After the redemption, A owns 50% and B owns 50%. And that's after. So I mentioned this in the last problem, variation 2. So think about this. If A and B need to vote on a decision, let's say they're a retailer. I know I keep using that same example. I love this example. Let's say that the corporation is a retailer and they're having significant growth online. They started off though as a brick and mortar retailer. The decision or the question is for voting, and this is something that the shareholders are the only ones that can vote on this. Not board directors, not manager, not CEO. Shareholders have to vote. Whether the corporation should close down all the brick and mortar stores and just focus on its online retail. That type of decision is something voted on by the shareholders. If A votes for yes, B votes for no. Before this redemption, A wins, and guess what? We're closing down the brick and mortar stores. But after the redemption, 50-50, guess what? Stalemate, so probably no result. So you're saying, okay, well, isn't that the same here? Because Orange and Lemon together, they own 52% after they own 50%, and they lose that ability to make that decision. The main difference, though, in this problem is that we don't have 2 shareholders. Now, Orange and Lemon, technically, under the tax law through attribution, are viewed as 1 shareholder. So that means that we have Orange and Lemon, 1 shareholder, plus Lime, plus Cherry. So we really have 3, if you think about attribution, 3 shareholders. We have the Lemon Orange as 1 shareholder, as an attribution shareholder, 1. Lime, 2. Cherry, 3. So let's say we have a similar decision. Lemon and Orange, together as 1, they vote for closing down the brick and mortar stores. They vote yes. So yes to closing down, okay? Before the transaction, guess what? They win, 52%, okay? Lime and Cherry vote no. So before Orange and Lemon, as 1 shareholder, since they have 52%, they win. Again, the tax law through attribution treats them as 1. Even though Lime and Cherry voted no, they're under 50%, so they would lose, and the brick and mortar stores would be closed even against their will, or against their decision. When we go to 50%, okay, Lemon and Orange, they're at 50% and they vote yes, okay? But what if I said we don't know the result of Lime and Cherry? We don't know what they want. Maybe Lime is adamantly no. Lime does not want to close the brick and mortar stores because Lime's been around since the beginning when it started and it was only brick and mortar, there was no internet. However, Cherry, a newer shareholder, is on the fence. They could be easily swayed, okay? Now think about this. If Cherry teams up with Lime, Cherry and Lime, there's not going to be any vote, any control, no effect. But if Cherry teams up with Lemon and Orange, guess what? It will make a difference. So if Cherry's on the fence and Cherry wants to maybe gain some favor with Lemon and Orange, who already control, they already have 50% close to control, right? Like they only need 0.0001% to have control. Maybe Cherry will vote yes and swayed with that side just because again, Cherry wants to be in the favor of Orange and Lemon. If that's the case, guess what? Orange, lemon, and cherry. Again, lemon and orange are one shareholder, but orange, lemon, and cherry vote yes, and against lime's wishes, they close. So can you see how that's different from one other shareholder? If lime and lemon and orange, right? If we just, okay, let's just make it a little bit simpler. Again, I keep saying orange and lemon, again, because that's a tax law. They view that as one shareholder. Let's just say we had lime and lemon. Both own 50%. And that's what it's going to be. If lime would not be easily swayed to get favor because lime knows, hey, I have 50%. Lemon's not going to ever have more than that if I keep the 50% or the other shareholders. So I don't really care what other people think. But then when you have this situation, cherry at 23% ownership, well, actually it's more than 23% because it's 23 over 96. It's probably like 24 or 25%. Cherry at a 24 or 25%, even though significant minority, right, when you view by itself, can have the favor of lemon and orange, and they could team up as a trio in the future and make decisions. And cherry might be one of these people that wants to be in part of the majority group. Okay? Similar things happen in politics, by the way. If you think about it, the House, the Senate, these types of things. Groups get together and they do this. They get votes, and the more votes that they get together, they might be able to get a majority or supermajority. But by themselves, not really. So the same thing happens in politics. So I would say, and so would the tax law, they would say that these two situations, the revenue ruling with only two shareholders, and even though they go from 52 to 50%, right here, which is similar, 57 to 50%, these are two different situations. Now, in the previous situation with orange, lime, lemon, and cherry, variation 2, it went from 52% to less than 50%. I think that's the difference because in that situation, you don't have the 50-50 change. Once you go below 50%, I think that makes a good argument. But here, it's very different when you compare the revenue ruling of 75-502 because there's two shareholders. Here, there's really three, right? Because lemon and orange are one, lime and cherry are two other ones. But again, in the revenue ruling, there was only A and B, and B doesn't care about what A thinks because B is going to keep 50%, A keeps 50%, it's going to be equal. Okay? So you don't have other people that can kind of make up that percentage. So this is not going to be a Section 1001 sale or exchange. It's going to be a Section 301 distribution. Okay? Very likely. More likely than not, I should say. Again, you can have arguments for both sides, but more likely than not, it's going to be a Section 301 distribution. The courts would that's how the courts think about things. They think about the possibilities of how this works. Okay? So we have a Section 301 distribution of $4,000 to lemon, right? $4,000 301 distribution. We apply the corporate distribution checklist. We have enough EMP, so all $4,000 would be distribution. If there's no other transactions that occur during the year, EMP would be reduced to $496,000, okay, for the corporation going forward. The adjusted basis of the shares left over, well, lemon has a basis in the shares. Lemon had 24 shares before times $900 per share. That's going to be $21,600. Okay? If you took $21,600, you divide that by 24 shares, you'll get $900 per share. But now, there's not 24 shares, there's only 20 shares. There's 20 shares left, so 21,600 divided by 20 is going to be $1,080. This is a basis. That's the adjusted basis per share, which you need to obviously know for lemon going forward what the adjusted basis per share is. Okay, that's the adjusted basis per share. So again, this one is kind of iffy, but it's more likely than not that it'll be treated as a distribution again because you can make that argument that hey, two shareholders, you're at a stalemate, but three, you can sway maybe potentially another party like cherry. Yes, lime might not agree, but cherry might be on the fence, so you have more ability. More ability is the issue. In variation 4, we're going to take a look at this and we're going to see some interesting new facts. It's going to be a lot different from what we've seen. So again, the facts stay the same up top to the chart. Fruit Loop redeemed 7 shares from Orange. Orange has no relation to the other owners for $7,000 cash. The shareholders are otherwise unrelated. So no shareholders here are related. Orange's basis in the stock was $900 per share. So first thing to note is that we have a redemption. Remember, we apply Section 302 to redemptions. Section 302 is going to what determines whether it's going to be the redemption, the buyback is going to be treated as a Section 1001 sale or exchange or a Section 301 distribution. Now, because there's no relation here to any parties, and there's no entity attribution or any issues like that, we have no attribution to apply. So that means that it's simply just going to be whatever Orange owns. Okay, it's going to be direct ownership by Orange. So Orange is before percentage. Okay, before is going to be 28%, just the 28 shares over 100. After percentage is going to be 28 minus 7 is 21. So 21 over a total of 100 minus 7, 93 shares, because there's 93 shares outstanding afterwards. So 21 divided by 93, 22.6%. 22.6%. Okay, so we go through the 4 tests. So test 1, our starting point, is always substantially disproportionate because it's the most mechanical of the tests. Remember that our after percentage must be less than 50% of the voting percentage. The after percentage must be less than 80% of the before percentage, and that's for voting. And finally, same thing, the after percentage must be less than 80% of the before percentage for all classes of common stock. So, of course, it meets the after less than 50% because afterwards we have 22.6%. So that's met. The next thing to test is, okay, if we take 28%, if we take 80% times 28%, we get 22.4. Ooh, we're really close. We're really close, but unfortunately, these tests both fail. Because remember, these tests for this problem are equal because the voting and all classes of common stock are the same. We are at 22.6%, 22.6%, which unfortunately is not less than 22.4%. It's not. So therefore, we fail test 1. Test 2 and test 3 also fail. Test 2, remember, is the complete termination. In order to have complete termination, you have to have direct ownership completely gone. Indirect, through family attribution waiver, another story, but unfortunately, it has to be gone. Direct does, which Orange still has ownership after, still owns 21 shares. So there's no complete termination test 2. Test 3, partial liquidation. Nothing in the facts about partial liquidation, so we don't worry about that. So finally, we go to test 4. Test 4 is the not essentially equivalent to a dividend test. Okay? So under test 4, not essentially equivalent to a dividend, NEED. Remember that the Davis case, the key language is a meaningful reduction of the shareholder's proportionate interest in the corporation, also known as a meaningful reduction in control, where we focus specifically on the shareholder's voting power because that's a super factor, a key factor. So here, the ownership is the voting percentage because that's the only really type of stock. It's all voting. So there was really 2 revenue rulings that we used. Okay, the first one was revenue ruling 75-502. And revenue ruling 75-502, before the redemption, the shareholder, there was 2 shareholders, owned more than 50%. Afterwards, the shareholder owned exactly 50%. Well, that's not present here because before we have 28%, after we have 22.6. So revenue ruling 75-502 is irrelevant. But what about revenue ruling 76-364? This is known as the concert issue. So we haven't really seen the revenue ruling 76-364 yet, but you're going to see it here. This fact pattern is specifically meant to get at revenue ruling 76-364. So the idea here is, okay, before the redemption, Orange has a measly 28%. Orange does not control the corporation. But look at the facts. Look in more detail. Think about the situation we have going on here. Again, before the transaction, Orange has 28 out of 100, 28%. Lime has 25%, 25 out of 100, 25%. Lemon has 24 out of 100, 24%. And cherry has 23 out of 100, 23%. If let's say there was a vote, a shareholder vote about an issue, could be the issue I mentioned earlier, like to cease the brick and mortar store. If orange teams up with any person, lime, lemon, or cherry, guess what those two people have? They're unrelated, right? So we don't worry about related parties. Unrelated. They have more than 50%. They have control. So if orange wants to vote yes to close down the brick and mortar, lime and lemon vote no, but cherry's on the fence, well, if cherry teams up with lime and lemon, of course that's going to be the case. But maybe cherry says, you know what? I'm going to go with orange. Well, orange then and cherry would win because you have 28 plus 23 is 51. If you did have any other person of orange, right? Orange plus one person equals more than 50%. But for cherry, lemon, and lime, they'd have to get together if they didn't have orange's ability because look at any other person. Lime plus lemon is 49. Lime plus cherry is 48. Lemon plus lime is 49. Lemon plus cherry is 47. Cherry plus lime is 48. Cherry plus lemon is 47. So they don't have that ability that orange has to team up with just one person to get control, right? Orange, 28 plus 25 is 53. Orange plus lemon is 52. Orange plus cherry, 51. So all that orange needs is just one person. The other people don't have that. That's exactly what the issue was in Revenue Ruling 76-364. One of the shareholders, there was multiple shareholders, just kind of like what we have here, was able to team up with just one person, and the other shareholders didn't have that ability. Now, after the redemption, the shareholder lost that ability, and that was viewed as a not essentially equivalent to a dividend. Okay? So let's see if that happens here. After the redemption, orange has 22.6%. Lime, so orange has 22.6%. We have lime. Lime is going to have 25 over 93 shares. 25 divided by 93 is going to be 26.9%. 26.9%. Lemon is going to have 24 over 93 shares, because again, 7 were redeemed. So 24 divided by 93 is 25.8%. And finally, cherry, that's 25.8. And finally, cherry is going to have 23 over 93 shares, which equals 24.7%. So again, before this transaction, orange could team up with a lime, lemon, or cherry. Didn't matter. Just one person, it would be more than 50%. Afterwards, orange has 22.6. Take 22.6 plus 26.9. Guess what? It's less than 50%. It's going to be around 49.5%. There's going to be some numbers because by rounded, right? There's going to be some decimal places and whatnot. But you're talking about 49.5%. Orange with lemon, 22.6 plus 25.8. You've got 48.4%. And then orange with cherry, you've got 22.6 plus 24.7%. You've got you've got 47.3%. So now orange goes from being able to control with one person to not being able to control with any one person. That is viewed as a significant reduction in control, okay? Because that should be a plus, not an X. An X for a significant reduction. The tax law, the revenue ruling would view that as orange no longer has the ability to control or a significant reduction. So this is viewed as a not essentially equivalent to a dividend. Now, of course, just like always, subjectivity. Section 302B1, not essentially equivalent to a dividend. What would happen if, let's say, there was a number where orange could team up with some people but not others? Maybe orange could team up with lime but not lemon or cherry. Would that be viewed as a reduction, going from being able to control anybody to now just being able to control just lime and not lemon and cherry? That's a great question. That's where, again, Kind of like we saw in the last two fact patterns, variation 2 and 3, where we had some differences from the revenue ruling, where you might be able to argue for both the government and the taxpayer. That just shows you subjectivity. I'm only going to deal with this situation to show you how the concert issue works. But this for sure is going to be just like the revenue ruling, and this is going to be not essentially equivalent to a dividend under the revenue ruling standard. So therefore, it's going to be treated as a Section 1001 amount realized. So our amount realized is going to be the amount received, which is $7,000, minus the adjusted basis of the shares. The adjusted basis of the shares here, we've got 7 shares at $900 per share, so that's $6,300. So that's going to be a $700 long-term capital gain, assuming that Orange holds the stock for more than 1 year. The adjusted basis of the shares going forward, that's going to be $900 per share. $900 per share, and the remaining 21 shares. Okay, $900 per share. The effect of EMP and all that stuff, again, we mentioned that stuff in an earlier discussion. We're not going to go into the specifics there, but it would have effect on EMP and whatnot. It would affect EMP. All right, so that is variation 4. All right, so in variation 5, we're going to kind of look again at variation 4, but we're going to look at the opposite side of the picture, right? We've been focusing on Orange and the ability to control with one person, but what about if you look at one of those shareholders and how they were able to control with Orange, just Orange, and then they lose that ability when they go down? Okay. So Fruit Loop redeems 5 shares from Cherry, who is Lime's brother, for $5,000. The shareholders are otherwise unrelated. Cherry's basis in the stock was $900 per share. So we have a redemption. So we know that, okay, Section 302, we have to look at that. And we're going to have to determine whether it's going to be a Section 1001 sale or exchange or a Section 301 distribution. So we do have a relationship here, right? But we don't know whether it's attribution or not. We have to analyze that. So our attribution analysis, we've got Cherry, who's at issue, and Cherry has a sibling because Cherry is the brother of Lime. So Cherry has a sibling, and that's Lime. The rules say that family attribution applies to parents, children, and grandchildren, and spouses, but not to siblings. So that means that there's no attribution here. It's just going to be direct ownership by Cherry. So let's go ahead and do the before percentage and the after percentage. So the before percentage, of course, is the number of shares that Cherry has, 23 over 100, 23%. The after percentage, we're going to have 23 shares minus the 5 redeemed. That equals 18. 18 shares now Cherry has, divided by 95 shares outstanding by the corporation, right? Because 5 have been redeemed. That equals 18.9%. 18.9%. Okay? So we do our step 1, or test 1, right? Test 1, which is substantially disproportionate test. Remember, there's 3 elements there. The first element is that the after percentage is less than 50%, and that's for voting. We also have to meet the after percentage is less than 80% times the before percentage, right? And that's also for voting. And finally, the after percentage is less than 80% of the before percentage, but it's for all common stock. For all common stock. Okay, so of course, after percentage is less than 50%. We see that. The after percentage is at less than 80% times the before. So let's go ahead and calculate that. Okay, so the after percentage is 18.9%. Is that going to be less than 80% times 23%, which when we calculate that, that's 18.4. So we're close, but unfortunately no cigar, right? We fail because we're not less than 18.4%. And both these tests are the same because, again, in this fact pattern, voting common stock and all common stock are the same. So we fail the substantially disproportionate test. So we go to test 2, complete termination. So remember, complete termination, even with family attribution waiver, you need to have direct ownership at 0, which we have 18.9%. So we fail test 2, complete termination. Test 3, partial liquidation. No facts here suggest partial liquidation, so we can move on from that. Okay, we go to test 4. Test 4 is not essentially equivalent to a dividend. Again, this is always the last test because it's the most subjective. And remember, under the US v. Davis case, meaningful reduction of shareholders' proportionate interest in the corporation, which is usually viewed as control voting stock, is viewed as a not essentially equivalent to a dividend. Okay, so we can't really we have the 2 revenue rulings. We can't really use revenue ruling 75-502 because the before percentage was 57% and then it went down to 50% with 2 owners. Here we have less than 50% ownership, so that's not what it is. However, revenue ruling 76-364 is the concert issue. Now, we just talked about variation 4, where revenue ruling 76-364 was pretty much on point, where we had Orange teamed up with any person, could control, and then afterwards could not control of anybody. So the issue here is that before, Cherry has 23, and if Cherry teams up with Orange, that's 51, right? So let's say that Cherry wants to vote yes for our decision we've been talking about throughout the whole video, whether this retailer, right, we're inserting some facts, this retailer is going to close their brick and mortar and only do online. Cherry says yes, Lemon says no, Lime says no, but Orange is on the fence. If Cherry and Orange say yes, guess what? They win. Because they have 23 plus 28, 51%. Boom, we have more than 50%. We have a vote. And we're going to be closing the operations. So before, if Cherry teamed up with Orange, right, Cherry could control with Orange. After, though, if you run the numbers after, okay, and we're just going to focus on Orange only. We're only going to look at Orange's number. Orange's after number, Orange still owns 28, but there are now 100 minus 5 shares, 95 shares. So 28 divided by 95 is 29.5%. 29.5% plus 18.9% is 48.4%. So if we take Orange plus Cherry after, we get less than 50%. Okay? We get less than 50%. Because we get 48.4%. So the question is, the fact that Cherry goes from being able to control of Orange to now not being able to, right? Where if Cherry voted with anybody, with Orange having the most, Cherry would not be able to control, even though Orange is by itself. The question is that not essentially equivalent to a dividend? And under the law, the revenue ruling, this would be viewed as not essentially equivalent to a dividend. Yes, it would meet this. So basically, we're looking at the opposite end of the spectrum. If somebody could team up with one person and they lose that ability, is that enough? And yes, it is. Not essentially equivalent to a dividend, and it's under that revenue ruling. The same rationale. So that means this is going to be treated as a Section 1001 sale or exchange. We're going to do amount realized minus adjusted basis. Okay? The amount realized here is $5,000 minus the adjusted basis. The adjusted basis here, we're giving up 5 shares, $900 per share. So that's minus $4,500. There's a $500 gain. Assuming it's been held for more than a year, Cherry held the stock for more than a year, long-term capital gain. And the basis per share going forward is $900 per share. Okay, $900 per share. And that's the adjusted basis of the remaining 18 shares. Okay, that's the adjusted basis of the remaining 18 shares. So that's how we do this. You've seen through the variations, we kind of have to think about, okay, how does someone control? Because again, we're focusing here on a meaningful reduction of shareholders' proportionate ownership in the interest of the corporation, which we focus on shareholders' voting power. So we kind of like take it into context. What would happen if we took it to a vote? Would it change before and after, right? If Cherry teamed up with Orange before, yes, it works. After, doesn't work, or any person, right? So that's kind of how this works. So I hope you've enjoyed this. Very interesting, right? If you're in my class, I'm only really going to test you, or you need to know the specific situations, because of course there could be lots of subjective issues here. So just know the specifics. But if you're taking another faculty member, you might need to be able to point to some of these issues where, okay, here's subjectivity, here's the ability kind of to identify these types of issues in your analysis. So just know that. All right, I hope you've enjoyed this video. I hope to see you in future videos.